Good Wednesday morning, 30 minutes until the start of the cash trade, and futures are higher again. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, President Trump delivers a primetime speech as optimism grows over a potential end to his war in Iran.
Nike stumbles, the retailer issues a surprisingly gloomy outlook for the year ahead, citing global headwinds.
Plus, OpenAI raises $122 billion in its largest funding round yet, pushing its valuation to $852 billion in total.
I have another piece of breaking news just crossing now on some other tech movers. I want to show you what Intel and Apollo are doing, because this is actually a deal that I talked to Apollo about in 2024, that they and Intel were going to do this giant JV to invest in a data center in Ireland. Well, now Intel has agreed to pay $14 billion to buy back half of that plant in Ireland. Originally, it was an $11 billion deal. Intel's starting to move lower. Maybe there's concerns about them spending more money. Apollo was up 1.4%, rallying with most of the financials in the market in this big relief rally we've been getting.
All right, so Apollo makes good money on that deal. Nike expects revenue for the fourth quarter to be down 2 to 4%, with the company noting that its turnaround efforts are taking longer than originally planned, but the direction is clear, lower, and the stock is off 12%. Furniture giant RH, Restoration Hardware, is plunging after earnings missed estimates as tariffs and bad weather apparently weighed on demand for furniture, which normally, Dani, we keep indoors, right? But Restoration Hardware, I think investors calling that bluff, down 22%.
Well, everyone has a lot of good excuses. We were talking about Beyond Meat this morning, who missed estimate, and it's because of Maha, apparently. It's because of all the false pseudoscience around red meat being bad for you that they did poorly.
But it doesn't taste good. That's an important aspect of food, right? It's supposed to be enjoyable.
I am almost positive that they would disagree with you on that point. Matt, let's get back to our top story this morning. Oil dropping ahead of President Trump's address to the nation tonight at 9 p.m. He just sent a new post. It reads, thus, Iran's new regime has just asked the United States of America for a ceasefire. We will consider when the Hormuz Strait is open, free, and clear. Until then, we are blasting Iran into oblivion. Let's compare that with yesterday, when the president suggested that the U.S. would pull out of the region with or without a deal around the Strait of Hormuz. Joining us now is Wayne Sanders, Bloomberg Intelligence Senior Defense Analyst and retired Army Colonel. Wayne, I don't even know where to go with this. What do you make of this back and forth? Do we care or do we not care?
Is it an objective or is it not an objective?
Yeah, there you go.
Yeah, I would say it's an objective. This morning on Bloomberg Surveillance, you guys would laugh. One of the conversations was about the movement of the USS George H.W. Bush and start moving towards another aircraft carrier into the region would have one of two different outcomes. It's either because you're looking at creating one last final blow, where I use the phrase of bombing back to the Stone Age, and then here it's coming out, in that context right now. Or the alternative of that is it would be in a protracted conflict perspective. So in one aspect, I'm not surprised that this is the direction that it's going. I think the ceasefire portion, the military is not going to stop unless it's asked to stop, right? I think that's key. Iran's also not going to stop. We saw that in the Iran-Israel 12-day war as well. They even shot at each other even after the ceasefire a couple of times and just some skirmishes. So until things are actually signed, you're going to see continued strikes and continued military operations.
We, have you at Bloomberg Intelligence because of your vast experience in the military, in military intelligence, at the Department of Defense. It strikes me that the president has started to say new regime. He thinks there's a new regime in Iran, even though the IRGC is still firmly in control and the Ayatollah's son, possibly even more radical, is the supreme leader. How come the president thinks there's a new regime?
Yeah, I think he's looking at it in terms of who he is actually dealing with, right? I mean, I don't think at this point in time he's dealing with some of the remaining IRGC leadership. He's dealing more on the presidential side, and I think that's the reason why he's looking at it that way.
But that president was the president before he started this war.
Correct, but he was also looking for how much influence is being exerted by the president versus the Ayatollah regime portion of it. And I think he's hoping that there's actually going to be a shift. I haven't seen the evidence to that yet, but obviously he has a lot more assets than I do.
All right, retired Army Colonel Wayne Sanders of Bloomberg Intelligence, appreciate you jumping in here. Now, we have seen a massive move on Optimism. We thought that the war would end, but now it's starting to look like, according to trading desks, including JP Morgan and Goldman Sachs, that what we actually saw yesterday was a massive short squeeze, contributing to the biggest rally in stocks in more than 10 months. Headlines around a push to end the war from the U.S. and Iran basically triggered a rush to dump bearish bets. Bloomberg senior strategist Jan Patrick Barnard reported on this, and it's also due to, JP, I guess, the end of the month, the end of the quarter, so pension funds putting money to work, and reversal of the short gamma positioning that dealers had.
Yeah, absolutely. It's a mix of things, and certainly like the headlines, even though we like get a bit of a contradiction today from President Trump, have certainly helped, and it shows like the market is looking for an off-ramp and wants an off-ramp, just given how bearish the positioning has become. But it also shows you like that this is a phase right now where I feel like it's more about market mechanics. And not so much about the fundamentals and the sentiment, actually, because we have seen so much shorting in the last couple of weeks from hedge funds, from trend following investors. We have seen like de-risking from all sides, corners of the market, even though if the decline of the S&P 500 was rather shallow at the beginning. But still, so I feel like we're in a market that is more technical than fundamental, because, like, I mean, if everybody tells me we can already like foresee that this conflict is over, and that we, on top of that, can foresee what that conflict will have kind of an afterplay in terms of corporate earnings and macro data, I'm very skeptical about this. So I would take this as a very short-term, very technical move, and not so much about a change in sentiment or optimism, or broader optimism among investors.
Where does it leave us then, JP? Do we have a sense of current positioning? Are shorts covered? Does that give us room to load back up? What does it all say about the trajectory from here?
Well, I would say like this is the first like typical impulse where you have the ultra fast money, and those would like the let's say the most strict risk management, that they exit the position because they are like always at risk of being squeezed into a move if this plays out to actually be an off ramp for that conflict. But I would say we are now at the point where, I mean, it sounds a bit lame, but both things can happen. I guess, like, if Trump is now backing off from anything of ceasefire and Hormuz is back on the table, that it has to be opened, then this conflict will certainly go longer, more bombs will fall, and then the market will probably move back into, like, higher oil prices and lower stocks in the broadest sense. If we, like, even tonight get, like, a real roadmap for an off-ramp and real evidence of talks and an idea of how this is going to be resolved, then I guess we will see more short covering, because then probably today and yesterday was only the beginning.
JP, appreciate it. That's Bloomberg's Jan Patrick Barnett. Now, elsewhere in stocks, check out what some of the retail sector is doing. Nike getting punished, down 12%. RH also down 23%. Both of them warning of tough times ahead as both earnings outlooks disappointed due to changing consumer habits, like around policies like tariffs. However, U.S. retail sales, they did increase in February by more than forecast, including a rebound in auto purchases. ADP data also came in hot. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now. And maybe Nike and RH have its own thing going on, but it does sort of stand out the contrast between companies' views going forward and I guess maybe now stale data in February for the retail sector.
Retail sales were February data before the war, and certainly retail sales are denominated in dollars, so it's going to be affected by the rise in gasoline prices. The maybe good news is ADP. Now, I don't know, you said coming in hot. I don't know what hot means anymore, because they said they found 62,000 private sector jobs, which is better than was forecast for them, but lower than the survey we have for Friday's private sector jobs of 75,000. You can see on the chart there that that ADP has not matched up well in the last couple of months with what we get from the government. Last month, they said 66,000 jobs, and the government found, in terms of private sector jobs, a negative 86. So we'll see what happens on Friday. But back to retail sales. we're looking at what I call antebellum sales before the war. And retail headline did come in fairly strong, up 0.6%. And you take out gasoline prices, it was still up 0.6%. But remember, prices are a lot higher now. The core is what we care about. That goes into GDP, and it was up by 0.5. So a little bit of extra strength for the first quarter. The biggest movers, health and personal care stores, clothing stores, both up over 2%, and motor vehicles were up 1.2%. The interesting thing, grocery stores were down a percentage point. I don't know if we were, going to get our nails done and did not eat or something like that during the month, but it is what it is. And again, this isn't going to tell us much about what's going on, although it's interesting that clothing stores and clothing accessories were up as much as they were when you see something like RH and Nike being down.
What do we get? At 10 o'clock, we get ISM manufacturing, right? And manufacturing has been, it had been a goal of the Trump administration to boost the manufacturing sector in the U.S. Of course, that goal may change at a moment's notice. But what are we expecting to see today?
We're expecting a slight rise, and it would be the third month in a row where we have expansion rather than contraction for ISM. But we're going to be looking at the underlying indicators. Obviously, employment, ADP found 7,000 jobs lost in manufacturing during the month. But the real interesting number is going to be prices paid, because it's a sentiment number, doesn't depend on the actual price of petroleum. It depends on what the purchasing managers think the price is going to be and how it's going to affect them. And there are some people thinking we could see almost a record number on that.
All right, so that data coming in just under 50 minutes time. Mike, thank you very much. Bloomberg's Mike McKee. And let's get a check on your markets this morning. 20 minutes to go until the start of cash trading. We are still up today. We are holding a gain, which was the best end to a quarter since 2008 after a very rough quarter. It was the best day in general since last May, when we had the U.S. and China reach a sort of détente over Liberation Day tariffs. You're seeing yields, those moving higher this morning. We're at 4.33 on your 10-year yield. The Bloomberg dollar spot, that falls 0.3% this morning. I don't know if we have oil in there. Oil,
we have a whole separate board, actually.
Oh, yes, we do.
I put together two boards today.
Matt, please take it away.
Well, I thought it was important to look at two boards here because we have so many assets that are moving. The volatility has just increased with this war, and perhaps that's also part of the goal. But NYMEX crude right now is
at 100.
Is down 80 cents. It's still at 100. This is WTI, even though we're energy independent. We're still seeing NYMEX, West Texas Intermediate, rise with Brent and terribly close to Brent as well. It's only $1.25 away there. So Brent crude at 102.26 right now, down 1 2/3%. Gold actually moving a little bit higher to 47.30, so getting back closer to that 5,000 level that it had been. And Bitcoin holding pretty steady at 68,377. It's been about 70 grand throughout the war. Let's take a look at some of the single stock stories.
Yeah, Raymond James, they've upgraded Disney to outperform from market perform. They say that this is an attractive entry point for the stock, which shares are moving higher by 1% in the pre-market.
Anglo Gold among the miners rising as investors anticipate de-escalation in the Middle East. Funny how this worked out, right? We invade Iran and gold falls as it looks like we're getting ready to pull out, although we are sending another aircraft carrier there.
And gold did rally
rises
3.5% yesterday, which was pretty wild. Microsoft is in exclusive talks with Chevron and investment fund Engine Number One over a long-term deal for a giant power plant in West Texas. Chevron down, Microsoft up.
Coming up, OpenAI is inching towards a $1 trillion valuation after a massive funding round. It got more than $100 billion in fresh cash. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. NASA astronauts blast off today on a 10-day journey around the moon. It will mark humanity's return to the lunar vicinity first return in over half a century. The crew will launch from the Kennedy Space Center in Florida, soon to be renamed the Trump Kennedy Space Center. I jest. That's tonight at 6:24 p.m. Eastern. The mission includes several firsts, including the first woman and the first black astronaut to fly near the moon. The mission has also been plagued by soaring costs, repeated delays, technical shortcomings, and operational complexities. It hasn't gotten a lot easier in 50 years. Nissan is urging Washington to ease tariffs on Mexico-built cars, warning entry-level models could become unaffordable. The automaker says tariffs add up to $3,000 per vehicle and can't match low-cost production in the U.S. Meanwhile, President Trump is posting about Nissan's success in the U.S. on Truth Social. As you can see here, I'm sure you follow him anyway. We'll talk to Nissan Americas chairman Christian Meunier in the next hour, and I'm looking forward to it, having driven the new Armada. OpenAI is now valued at $852 billion after raising $122 billion from backers including Amazon, Nvidia, and SoftBank. The deal is the largest transaction in history as the ChatGPT creator positions itself to become the backbone of the AI economy. At least that's what it hopes will happen, Dani.
And let's bring in Bloomberg Intelligence head of global tech coverage, Mandeep Singh. And Mandeep, this means that if OpenAI were to be a public company today, it would be the 13th largest in the S&P 500. All of this seems like a run-up also to it becoming a public company later this year.
Well, I mean, they have certainly made a pivot, from focusing on consumer ChatGPT subscriptions to really going towards more enterprise use cases. And really, I think when you look at Anthropic's growth, I mean, all of that growth that they have had, they've doubled their revenue since the end of the year, Anthropic has, and it's driven by coding agents used in enterprises. And so OpenAI is definitely playing catch up. That's why they moved away from Sora and the instant checkout. And it's a pretty hard pivot. I think $122 billion is a big number. I would be curious to see if they're just hoping on AI agents deployed at enterprises, or there is more to using that money that they're raising. But right now, it's really enterprise play for everyone.
How are they doing in terms of the competition between different chatbots? Gemini at first was lauded for being really useful. Claude got a lot of subscribers after they refused to let the Pentagon, use AI to do surveillance on the American people, and OpenAI said, we're game. Are they still far ahead?
So I look at the token consumption, which is probably the best metric to measure the usage of these LLMs across, enterprise and consumer use cases. And Google tokens have grown almost 20x in the past 12 months. They are at the top when it comes to token consumption because of the surface they have with their own family of apps, as well as the Google Cloud business. But at this point, OpenAI and Anthropic are neck and neck. I mean, the numbers are like 6 to 8 trillion tokens per month, and Google is somewhere around 30 trillion tokens. So from that perspective, it feels like Anthropic has definitely narrowed the lead, and that's where enterprise tokens are what you monetize. It shows up in your revenue. I mean, both these companies are guiding close to 25 to 30 billion in revenue by the end of this year.
By the way, what happened with Claude yesterday? Did they
their code got released?
And is that a big whoops, or?
It is. I don't think it was intentional. So from that perspective, you could argue, their controls didn't really work well. And look, I mean, they're talking about cybersecurity use cases and all that. Like, to me, this is the perfect case of where, a cybersecurity or one of those companies could come in and say, you have a process where you could be exposed, to code leaks and this kind of inadvertent stuff. So from that perspective, I do think they need better control.
All those cybersecurity companies who said AI will not replace us probably feeling a little bit smug this morning. Mandeep, just before you go, at the top of the hour, we learned that Intel is going to be buying back the rest of the Irish JV that they had with Apollo around a data center. Apollo, originally the stake was $11 billion. They pay it for $14 billion. I'm interested from both sides about why Intel would want to pay this back and why only after 2 years Apollo would want to exit this thing.
Well, right now there is clearly a boom when it comes to data center construction. And for a company like Intel, their best bet is onshore manufacturing. Like, what you really want to double down on is companies having to diversify their supply chains and, moving some of the chip production here. And so from that perspective, it does make sense. They did raise some money from NVIDIA, And so, that's probably the direction Intel is headed towards in terms of focusing on manufacturing here.
All right, Mandeep, thanks very much, Mandeep. Singh there runs Bloomberg Intelligence tech coverage for us. Coming up, Kestra's Kara Murphy is trimming exposure of mega cap stocks and pushing into industrials. She joins us with her market outlook next. This is Open Interest.
Perhaps a little bit of a preview of what we're going to hear from the president in his address to the nation at 9 p.m. tonight. Reuters reporting that President Trump will express his criticism of NATO tonight, that he says that the U.S. will be out of Iran pretty quickly, but that they can come back for, quote, spot hits once the war is over. Futures still rallying after that monster rally yesterday. We're up about 0.5%. NASDAQ goes up 0.7% as 10-year yield still moving higher at 4.32. And I know you're looking at the energy and commodities market.
Yeah, I mean, there's just so much to look at. So oil has been fluctuating. NYMEX crude has been fluctuating up and down around the $100 mark right now. We're at $100.16. Brent crude about $1.50 away at 101.86. Gold is rising today, and Bitcoin holding steady around $68,400 right now. So we have seen a lot of volatility. Mm-hmm. But it's interesting to see that oil, even with the market anticipating in some senses a retreat from the Middle East, is not selling off.
Because a retreat doesn't necessarily mean that the Strait of Hormuz would be open, although there's some question marks to that this morning about if that's necessary for a retreat. President Trump earlier in the week saying that we could leave without reopening the Strait. There was that Wall Street Journal report. But then today saying that in order for there to be a ceasefire, which he says Iran wants, that the Strait of Hormuz would need to be open regardless. Oil still falling this morning as futures point higher. We're going to have your market open for you just on the other side of this commercial break.
Moments away from the start of trading on this Wednesday. This is Bloomberg Open Interest. I'm Matt Miller. We're seeing big gains in futures, 0.5% on the S&P, 0.75% on the NASDAQ futures after massive gains in yesterday's trade, the biggest we've seen since May of last year, which was right after Liberation Day month. So I guess for the similar reasons, right? After Liberation Day and President Trump threatened the world with massive tariffs and the economy would have been greatly damaged, then he brought them down. And so we were like, okay, the economy can fly free now, soar like a pigeon in the sky. By the way, Paloma Acquisition Corp ringing the bell at the NASDAQ, and Paloma means pigeon, I'm told, in Spanish.
But apparently dove as well.
A dove is a pigeon.
Because again, my best friend's sister's name is Paloma, and I refuse to believe that her name is just Pigeon, that her parents named her Pigeon.
Well, yes, I know. It's probably because they thought a dove, a beautiful, peaceful dove.
Yes.
I think Picasso has a daughter named Paloma.
Okay.
In any case, my point is, we were worried about war. Right. March was a horrible month for stocks. In fact, more wealth was destroyed in the stock market in March than any other month in history. And so yesterday, when the market gets the idea that maybe President Trump is ready to back out of the Middle East, the closed straits of Hormuz be damned, that market rallied, although we know that there was a lot of short covering as well, pension funds coming in, and that the short gamma position of dealers had rolled off because of Tuesday's expiry.
I also think it's important, though, to compare it to Liberation Day, because at that time, it was Trump's switch to turn on and off. This time, it's not just his decision. It's Iran's, it's Israel's. Just because he says it's over doesn't mean that the Strait is open.
We'll see how it turns out.
Anyway, here at the Open, I am looking at deal news we had at the top of the 9 a.m. hour, Intel and Apollo. So in 2024, Intel and Apollo, they reach a JV to build a plant and a data center in Ireland. Originally, Apollo paid 11% for just under 50% of that data center. Now Intel comes back and says, thank you very much. We will buy the rest of that. $14 billion is what they're going to pay. Matt, over the 2 years, that's an IRR of just over 12%. That's a little bit under the average of what PE tries to achieve for it. But hey, for a holding period of only 2 years, maybe that's not so bad.
Yeah, better than a stick in the eye, I would say. That's what my stockbroker used to tell me. Nike expects revenue for the fourth quarter to be down 2 2 to 4%, with the company noting that its turnaround efforts are taking longer than originally planned. The CEO said the direction is clear, and he expects revenue to fall the rest of the year as well. So that direction doesn't look very promising, and as a result, Nike shares are down 13%. Furniture giant RH, which was previously known as Restoration Hardware, no idea why they would have changed their name to just 2 letters. It missed earnings estimates as tariffs, and it says bad weather weighed on demand. Restoration Hardware down more than 20% in the early trade.
Let's get more on these markets that are rebounding again after the rebound yesterday. Kestra Chief Investment Officer Kara Murphy joins us for more. What a quarter it was. And of course, yesterday is how it capped it all off. How do you think about your portfolio right now? And after the quarter that was and a huge rally on our hands yesterday, are you defensive? Did you lean into the sell-off? Did you buy? Did you pick up some of the babies with the bathwater? Where do you stand now?
So I think it's important to think about these conflicts as they tend to be relatively short-lived. They're very painful, and not least of which for the people who are directly impacted by it. But at the same time, when we look back through history, these types of geopolitical conflicts tend to be short. And then what happens is that...
You mean their effect on the market? Because
their effect
actually
on the
they
market.
take, like,
100%.
Vietnam, Afghanistan, they take a long time.
Yes, but the market's focus tends to be quite short, right? And the U.S. economy is very, very privileged in that we are very insulated from these types of conflicts. Now, the higher oil prices are the way that these conflicts tend to transmit to the U.S. economy. But again, we're much more insulated than the rest of the world. So what happens is that as the headlines start to recede, market participants then refocus on the trends that were in place before the conflict started. And I think that's where we're seeing an important market shift away from these Mag 7 names that have been so important for a number of years to a lot of other areas of the market that are beginning to show earnings power. And that, I think, will then draw the attention of the market.
So the Mag 7 had a tough start to the year, right? The whole market obviously did, but the Mag 7 index is down, 11, 12%. Do you buy that? Do you say, okay, this drop was amplified by the war, and now that we can look through that, hopefully, it's a cheaper set of stocks to buy?
I suspect what happens, like if you look at the Mag 7, actually, they actually peaked at the end of October. So that underperformance has been going on for a number of months. I think as the conflict hopefully comes to a resolution in the not too distant future, initially it's those Mag 7 names that are going to bounce back. Those are where valuations have come down, earnings estimates have really held in there. So that's kind of an easy place to go for some grounding. But as we kind of get past that, then I think in the back half of the year, you start to see smaller large caps, mid caps, small caps start to kind of come into their own when it comes to earnings. And that's the longer term trend that we see going forward.
How are you thinking about the impact if the conflict ends but the strait remains closed and oil prices remain elevated? What sort of impact would that have on your look forward?
That's our base case right now. We don't go back to $60 oil. But if we get back to, let's say, $80 oil, where the cost of doing business, the cost of transportation for oil is still high, that's still a very sustainable level. And that's also a level at which most American producers can be very profitable, right? So that becomes the ballast to all of this.
The broadening out that we were seeing, do you bet on that? Because earnings expectations are still pretty high for the whole S&P 500. Right?
Yeah.
Double digits.
Yeah, and that compares with like a 9% long-term average. Like, that's fantastic. And so even if we see a little bit taken off of there, right, if expectations come down a little bit, we've also had valuations re-rate down. And so that becomes a really big opportunity where you have solid earnings power, a little bit more attractive valuations.
Does the earnings power, though, stay if a consumer is still dealing with $4 at the pump? Like, is there a level at which the really strong consumer retail spending we got, I mean, February numbers were very strong, even though they were very backwards looking. Is there a level at which people start to funnel more of their savings into things like the cost of powering their car? They start to save more. They get nervous. Is there a threshold?
I think there is for sure a risk, but it's actually duration is more important than level. So the longer we stay at these high levels, the more damage it happens. But the uncomfortable thing to remember is that higher oil prices really impact the lower end consumer who's actually a much smaller contributor overall to the U.S. economy. High-end consumers are actually in really, really good shape. Wealth is at historic levels, leverage is at historic lows, and the amount of earnings that they spend on filling their gas tank is relatively small. So again, as we think about the U.S. economy in aggregate, it's very asymmetric who gets hurt by high oil prices.
You know, last year, the other markets around the world in Europe and Asia outperformed the U.S. Now, they needed to do some catch up after, a decade of underperforming. But is that trend finished now?
I don't think so. It has certainly been halted. If you look at emerging markets in particular, they've really been hit hard by these high oil prices. So you have to get that corrected in order to see some momentum come back in those names. But again, as we think about fundamentals, we think it makes sense to have exposure outside of the U.S., both because we're likely to see a continued pressure on the dollar. You have extraordinarily low valuations in those markets, and you're starting to see earnings begin to pick up.
What difference does it make the dollar going forward from here? Because we're seeing the dollar decline now as we look towards a resolution of the end of the war. It had been strengthening as the war coming up. How are you factoring that into your view forward?
Yeah, and then meanwhile in 2025 the dollar was quite weak, and so what we tend to see is that the U.S. dollar goes through these large cycles, and in periods when the U.S. dollar is appreciating, U.S. markets also tend to do better on a local currency basis. But we think that we're starting to come off of a very long period where U.S. dollar has been strong, U.S. assets have been ascendant, and it's starting to favor some of those assets outside the U.S. It doesn't mean the dollar is going to plummet, but on the margin, we think that outside the U.S. we tend to have the benefit.
All right. Cara, we're going to have to end it there. Thank you so much for joining us this morning. Great to see you. Kestra Chief Investment Officer Cara Murphy. And we are 8 minutes just over that into your trading day right now. We're not only holding on to gains, we are increasing them. We're now up 0.8% on the highs of the morning, the future session included, after a very, very strong day. We had the most advancers yesterday so far year to date. It's pretty good breath this morning, 325 stocks up. It's all of the big mega cap tech, as Cara was just talking about, that's advancing. They are now all trading below 25 times forward earnings, so maybe it's a nice little bargain if you want it. NVIDIA, Alphabet, Amazon, Broadcom, Meta are the best gainers. Micron, which had been selling off, up 5% this morning. Intel, we talked about their deal with Apollo. Those shares are also up by more than 6%. On the downside, you have consumer type companies, and you have energy names, energy falling with the price of oil. Nike down 13% after a lackluster earnings report where China did not perform as expected. McDonald's is in there, Visa, MasterCard, again, some really consumer exposed names like P&G. You're going to see that if you look at the sectors this morning too, that energy is performing poorly alongside consumer staples. Energy down 2.1% is the best performing sector over the past month, over the month of March. No surprise with that big move in oil prices, one of the biggest months since the Gulf War. Communication services with the tech giants, industrials, infotech. Those are your leaders this morning, Matt.
All right, coming up, Brian Ruder of Permira is going to join us to discuss his outlook for M&A. And by the way, today's the big day. Today is the hour-long M&A special starting at noon. Dani anchors that, and we have a lot to talk about with Brian. Looking forward to him joining us on this Bloomberg Open Interest. Quick check on what's going on in the early trade. We're up 0.5% on the S&P 500 after a massive rally yesterday. 65.61 is where we sit on the benchmark index. The NASDAQ up another 152 points to 23,895, so getting back close to 24,000. You got the small caps rising more than 1%. It's time now for top calls. Some of the analysts' action and focus this morning. First up is Raymond James, upgrading Walt Disney, saying the current slowdown and weaker international park traffic make this a good time to buy, with streaming profits expected to drive more growth over the next few years. Next up is Benchmark starting Microsoft with a buy rating, saying the company is becoming a leading force in AI and says investors should take advantage of the recent pullback. Microsoft shares had fallen yesterday 25% year to date. Of course, they rallied with the rest of the market. And finally, HSBC is upgrading Bank America and Wells Fargo to buys, writing that some bank stocks have overcorrected in response to rising economic uncertainty. Dani?
Dealmakers saw a very strong start to the year, despite a volatile backdrop as the war in Iran continues to cloud the global economic outlook. We spoke with Rich Lawson, who co-founded private equity firm HGGC, alongside Hall of Fame quarterback Steve Young, about what he's seeing in the market.
We all, I think, feel these profound implications of this geopolitical strife. But again, there are certain pockets of the alternatives, and particularly medium-sized companies globally, that are being transacted. We've actually bought a business in Canada. We've taken a business private in the UK. And we've also done a fund admin in Luxembourg in recent times. So deals are still happening.
Joining us now, I'm pleased to say, is Brian Ruder, co-CEO and co-managing partner at Permira. Brian, thanks so much for stopping by.
Thanks for having me.
And look, you have a better view than maybe anyone. Nearly 100 billion assets under management. You're headquartered in London, but you operate truly globally. It's all these existential risks. I mean, you and I were just talking about some of them, between AI, supply chains, war. What has this environment so far this year been like to invest in?
Yeah, it's energizing, but incredibly volatile. Volatility tends to create like really interesting environments to invest in. Looking back over the last couple of years, it was actually really tricky because we saw the markets being pretty highly valued relative to underlying risk potential. So volatility you could see in the world, but not volatility you could see in asset pricing. Today it's kind of reversed, and you see risk being priced everywhere, especially around the AI trade. So it's a really interesting time now. So we were saying before it was a good time to be selling beta, buying alpha, as in like the market we were kind of generally not excited to invest in, but you could have to pick really interesting selective assets where you could drive differential returns over several years. Now we actually see much more interesting opportunities with the way the market's being priced.
The AI, I guess, evolution has created kind of a reckoning for software especially. And it turns out that private asset owners are much more exposed to software than public markets. How does it look at Permira?
Yeah, we have a significant part of our NAV that's in B2B software especially, but it's a minority of where we've been investing. We actually have been a significant net seller of software for the last several years, and in fact, since the release of ChatGPT, not because we think software is in a bad place, but because we did not see this risk priced into software. So we saw better opportunities to sell software than to acquire. Recently, really towards the end of 2025, software moved into a really interesting price range, and we think actually now it's been oversold. Not necessarily in total, but there's really interesting single names in software that we think are significantly oversold.
You can go ahead and share some of those with us.
Oh, well, I tell everybody when they come to bring something to the investment committee today, it better look good compared to Workday at 9 times EBITDA, right? So it doesn't mean we're not going to buy Workday at 9 times EBITDA. We're not a public investor, but anything in the private market has to see that. The private markets have not yet reset to reflect those levels. It usually takes 6 or 9 months, as crazy as that is, for the private market to kind of see their way to what the public market reality is. But anyway, we think there's some really interesting names out there, and it will kind of work its way into the private market.
I was just thinking that your company Zendesk must be so happy that they're not a publicly traded company when all the wildness was happening.
Yeah.
So when you look in the market, if private hasn't caught up, are you actively having conversations with publicly traded companies that you're looking at taking private then?
The take private market has been a very consistent source of deal flow for us. It's a really good one. I don't know any public company that's happy they're public at the moment. And so we've taken companies public, we've taken more companies private than we've taken public, Zendesk being one of them. We've sold some of our public companies. We sold Informatica last year to Salesforce, which was a great trade for Salesforce, but we're very happy that that company's not public right now. So yeah, it's a really interesting time to be having dialogues with all of these companies about maybe it would be better off to be private in this kind of a world.
What's your take on the moat that's necessary, or what do you want to see in a software company? I mean, you mentioned Workday. I thought it was so fascinating that the CEO pointed out Anthropic and OpenAI still pay Workday on a monthly basis, right?
Yeah. We think there's a lot of overused kind of comfort terms that we see around software today. System of record, overused comfort term. Every application has a database, and you'll see people say, like, well, we're a system of record because we have a database. I'm like, nah, that doesn't really fit. You need to be feeding lots of other enterprise applications in the organization to have that kind of level of stickiness. So there's a lot of, like, moats have changed, and a lot of moats that we find really underwritable today are back to basics. It's regulatory protection. It's deep relative market share advantages relative to your competitors. And actually, a lot of what we've been doing with our existing portfolio companies, going back to 2022, 23, on the release of ChatGPT, was aggressive investment around AI innovation. We're now 600 million plus of real AI ARR in our portfolio, and that's growing more than 100% per year. So your best protection is actually to invest in and around the new
That's
technologies.
growing more than 100% per year. That's more than doubling every year.
Yes.
Wow.
And by the way, like you realize there's tremendous advantages in the AI era to being the incumbent because you have access to all of the context and workflows. That's actually the rate limiting step for enterprises to get real value out of all their investment. So we're thrilled, Zendesk being one of them. 200 million plus of that 600 million is coming from Zendesk alone, who made that pivot very successfully over the past several years and really embracing being now an AI native, AI forward company.
Some of your peers who maybe hold software companies that don't have that incumbent advantage, it's been sort of stacked on top of what people are saying is the bifurcation of private capital players right now, the haves and the have-nots. Davidson Kemper has some status that are hedge funds saying that roughly a quarter of PE funds that have raised since 2015 have failed to earn the rate of return at which firms can earn performance fees. There's been a lot of talk about the 21 and 22 vintages being really poor because of how much was paid. Again, that sort of shakeout, that bifurcation, have those troubles fully made their way through the system?
It never fully works its way entirely through the system, but there's been a very consistent trend of where especially institutional investors would like to put their capital, and it tends to be with firms that have some scale. So that's been a very consistent trend across this. There is a cycle to the industry. Some of that's driven by performance and vintage years and the like, and the vintage year you're talking about is going to be a very tricky vintage year, kind of 21, 22 era for the industry. But the industry always survives and thrives through that.
Is that making its way out, that vintage right now, where exits finally coming? Because I know there was some kind of indigestion of could the sellers and the buyers, could that gap come together? Is it coming together at all?
Yeah, it's still a low liquidity vintage across the class. We have been monetizing in our vintage for that. Like that underlying portfolio is actually growing really nicely. So the more you grow, you work out some of the prices that were paid during zero interest rate environment and the like. So but we think actually the assets you want going forward, we love our position in this because we're a digitally native investor across everything we do. Our second biggest office is Silicon Valley. Deep kind of roots in the Valley, but applying that technology expertise to all of the areas we invest, whether it's services, healthcare, consumer. We think that's actually the setup you want as a firm heading into the next decade of risk and opportunity around AI.
Brian, it's awesome to have you here, and as Dani points out, your perspective is really valuable, so I hope we can get you back on again. Brian Ruder there talking to us, he of Permira, but fortunately here at 731 Lex. We're getting some breaking news from the Islamic Republic of Iran Broadcasting Network, IRIB, citing the IRGC, saying that the Strait of Hormuz won't reopen based on Trump's absurd displays, and that's their word, not mine. As a result, you can see that we have paired some of the gains that we had on the S&P, although we're still up 0.5% at 37 points at 65.65. So it is, a headline worth paying attention to, and we've seen a couple of these big red sticky headlines cross the Bloomberg terminal. Just about an hour and a half ago, President Trump said he will only consider a ceasefire with Iran when the strait is reopened. So the president officially making that an objective, even though yesterday the Department of Defense Secretary Pete Hegseth said it was not an objective. Now Iran says they won't reopen the strait. So we'll continue to see, I guess, volatility in these markets. More on Bloomberg. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing after headlines cross, this time from Iran. We had President Trump earlier saying that he won't consider a ceasefire until the Strait of Hormuz is reopened. Remember, he said at the beginning of March, only when there's an unconditional surrender. But the Iranians say they're not going to open the Strait of Hormuz. As a result, we have some fluctuations, but still, 65.64, 65.66 right now. We're still up 0.6%. So the market really looking through those Iranian headlines. The NASDAQ gaining 0.75%, little more at almost 24,000. Take a look at crude. It's down 2.5%. This is WTI 98.77. Brent also down almost 3% at 101. So the market not buying what Iran has to say. Nvidia is up, and that's helping gains as well. Coming up the next hour, State Street's Marija Veitmane shares her take on this week's massive rally. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Markets are still rallying after the best day since May, but some of the rally capped. A lot of conflicting headlines. Trump saying that in order for a ceasefire, the Strait needs to reopen. Iran, according to the state-run media, is saying that the Strait will remain closed and that its future will be decided by Iran and Oman. But for the most part, oil still down, stocks are up. Matt.
All right, so yeah, exactly. The market looking straight through those Iranian headlines. We do have economic data. We had retail sales out this morning. We had ADP out this morning, adding 62,000 jobs for what it's worth. Now we're looking for ISM manufacturing and S&P Global Manufacturing PMIs. I see the S&P Global Manufacturing PMI as it came out 15 minutes ago, and Bloomberg's Michael McKee, our international economics and policy correspondent, is with us here at the desk. I don't see ISM numbers yet.
I see them.
Whoa.
And I will tell you what they are. Manufacturing PMI comes in at 52.7 for the month of March. That is up from 52.4 in February. The one everybody's been waiting for, prices paid, is at 78.3, up from 70.5. That's the highest since 2022. So a huge jump in the prices paid numbers. The employment number comes in at 48.7, still negative. 48.8 is what it was the month before. New orders 53.5, down from 55.8. Production 55.1, that is also down from 55.3. The other thing that I wanted to take a quick look at here is what the comments are that we're getting from people. And people are mentioning tariffs, geopolitical issues, and Iran are already waning sentiment. That's an interesting way to put it. People are feeling bad about the war. And current Middle East unrest is already starting to impact business operations by increasing lead times, costs, container delays, and the like. So this report does certainly reflect a lot of what's going on in the Middle East right now, and it's one of the more contemporaneous numbers that we have. The payroll number kind of matches up with the 11,000 jobs lost in the ADP survey this morning for manufacturing. So overall, not particularly good news. It does show a bit of a decline in business, and certainly a big rise in prices paid.
And two-year yields off the back of that at the highs of the morning at 380. They're up about 1.5 basis points. But the original rise for yields, at least on the front end, Mike, came around 8:30 when we got the retail sales dump number. Of course, that was in February. It's somewhat backwards looking, but also stronger ADP, very backwards looking. ADP figures too, stronger than expected also. I mean, regardless of what happens with this energy market and higher energy prices, it still feels like data that's coming in that's putting a Fed on pause.
Fed's on pause. The data have been mixed, but they show the economy is not falling off a cliff. We're not gaining a lot, but we're not falling off a cliff, and so the Fed doesn't have to do any rate cuts to prop up the economy. The only question is, how do they react to inflation? And certainly we're all expecting inflation to go up. Earlier this morning, Albert Musalem, the St. Louis Fed Bank president, had it both ways. Said if inflation rises, he's prepared to raise rates. If the economy weakens, he's prepared to cut rates, which is kind of where the Fed in general is.
That's what they're supposed to do.
I mean, as he said, risks are rising on both sides.
All right, Mike, thanks very much. Bloomberg's Michael McKee breaking down the economic data. We've had a ton of it this morning, and we'll continue to watch how it moves markets. Let's get, though, to Washington, because President address, he's going to address the nation tonight. The White House says it will include an important update on Iran. And B, the president is at the Supreme Court as it takes up his push to limit birthright citizenship. Bloomberg's Washington correspondent Tyler Kendall joins us now. Tyler, I guess there are two very separate issues. One seems core to his campaign, and one seems counter to campaign promises.
Yeah, so Matt, I guess we'll start with where I am here and what really marks an unprecedented moment, because this is the first time that a sitting U.S. president has attended oral arguments over one of his policies. And we can confirm that right now he is inside the Supreme Court. And this case really stems from that executive order that he signed on his very first day in office, barring U.S.-born children to undocumented immigrants from obtaining U.S. citizenship. And when you talk to experts, they say that this really comes down to just 5 words in the citizenship clause of the 14th Amendment. And that has to do with what is called, quote, subject to the jurisdiction thereof. We won't get too much into the wonkiness here, but essentially the administration is arguing that that standard requires a relationship of full allegiance to the United States, which the Trump administration says does not apply to undocumented immigrants and temporary visitors. Meanwhile, the challengers here in this class action lawsuit brought by the ACLU are arguing that this would go along against longstanding precedent that the 14th Amendment applies to everyone if you were born on U.S. soil. So it's going to be one to watch. The fact that President Trump is here really signals that he is doubling down on his hardline stance of his immigration policies, because I can tell you, I can see the Capitol Rotunda right across from where we are. We can't forget that in the backdrop of all of this, the Department of Homeland Security is currently shut down over some of those hardline immigration tactics.
So Tyler, on the other side of what Matt was asking you about and what the president has been squarely focused on is the war in Iran. We're going to hear from the president at 9 p.m. tonight Eastern. What are we expecting?
Well, Dani, we're going to have to wait and see, because we have heard quite a few statements out of the president, including this morning as you broke on this program, that he is saying that the U.S. will not agree to a ceasefire unless the Strait of Hormuz is opened. We should say there's been no public indication Iran has offered to unconditionally cease hostilities. Plus, you read the statement coming from Iranian state TV that Iran's foreign minister is saying that Iran and Oman will be controlling the future of the Strait. This after yesterday, President Trump said that we could see the U.S. withdraw troops within the next 2 to 3 weeks, and also made clear that he doesn't need to see an actual tangible agreement in place in order to cease the U.S. military operation. So there are so many threads that we could pull on here. Perhaps the Strait of Hormuz will really be that focal point, as President Trump has been ramping up his criticism of allies. In an interview published by The Telegraph earlier this morning, the president saying that he is now reconsidering the NATO alliance. Pair that with comments from Secretary of State Marco Rubio overnight, saying that it's time to, quote, re-examine that alliance. I would expect tonight we're going to hear a lot of pressure on our allies, but also President Trump touting what the administration has said has been tactical successes in the past few weeks.
Tyler, thank you very much for your reporting this morning. That's Bloomberg's Tyler Kendall outside of the Supreme Court. Joining us now is Marija Veitmane, State Street Global Markets Head of Equity Research. And Marija, what a quarter and what a day yesterday was. That huge jump, the biggest since May. The relief coming, maybe it's positioning, maybe it is this hope that the war will end. What difference does it make for you if you have a president who's saying that the war, he's able to pull out of it, but that might not mean that the Strait of Hormuz is opened?
Yeah, definitely what a day, what a quarter. And I mean, markets are very, very much headline driven. And I mean, headlines seem to be kind of two ways, right? So markets investors are very much watching their left tail risk and kind of possibility of kind of stagflationary outcomes and terrible for stocks and other assets, but similarly they're watching for the right tail risk, right? So this war can end with just one headline. So investors are really hesitant to reduce position, and what we see in our custodial database, institutional investors as a group, they still have not capitulated. They're still running large risk positions. We've seen some rotations from kind of potential winners and losers, but really no huge capitulation. So moves like we saw yesterday and like start of today probably going to continue, kind of the magnitude that investors should get used to it.
You know, I suppose the U.S. could just pull out of the Middle East. That is feasible. But I wonder how much damage has been done to the economy. I see some people with the view that this is short term, and if we leave, things go back to normal relatively quickly. That's the Secretary Bessent position. On the other hand, people like Christine Lagarde at the ECB saying, no, actually very serious damage has been done to infrastructure, and the global economy will be hurting for a long time after this. How do you view it, Marija?
I mean, it's interesting you bring, Matt, you bring out the U.S. and European officials, and actually very much that's what we see in our data as well. So institutional investors are leaving European stocks and going and kind of reallocating into U.S. So definitely very different perspective from like different potential economic impacts from higher oil prices in U.S. and in Europe. So Europe is seen as very much kind of the biggest loser from from the attack. It's obviously very energy-hungry economy, where economy was just beginning to kind of re-emerge from recessionary kind of environment. ECB cut interest rates, profitability began to improve, and now we're pricing higher interest rates, and that's very damaging for US, or for Europe. And US, on the other hand, I mean, if we look at kind of earnings expectations, they're still fairly robust, and it's been kind of valuation adjustment. So in terms of relative preference, yeah, Europe is definitely on the losing end, and hence the rhetoric, and US is maybe damaged a little bit less.
But can we really be successful? I mean, if I look at the S&P, I see a company like Nike, right? And Nike is not going to do well if it can't sell shoes in Europe and Asia. So, I mean, if there are damages to other economies, don't we suffer as well?
Oh, absolutely. And I think actually, to be honest, if you're thinking about economic damage versus stock market damage, I think 2024, 2025 are really kind of useful years to think about. I mean, we've seen quite a lot of economic damage, and you probably can argue that outside certain areas, U.S. economy has been struggling, and all this K-shaped two-speed economy is definitely there. Lower income consumer, smaller companies, there are definitely labor markets, there are definitely kind of damages to U.S. economy, but big tech is doing really well. Profitability is there, and that's dragging overall profitability in U.S., and that's supporting kind of equity market, not supporting economies that much, but in terms of equity market, that's probably kind of least damaged.
But Marija, and this is something you write about too, if we're starting to swing from inflation concerns to growth concerns, and that underpins the stock market because rates go lower, shouldn't that at some point, though, hit earnings estimates if growth expectations start to slow down with higher energy costs?
I mean, it's you're absolutely right. And growth I mean, we look at earnings expectation, and I mean, mind you, it's probably a little bit too early to draw like very strong conclusions. But in the last month, so since kind of the attack started in Middle East, what we've seen, earnings expectation overall for U.S. economy, U.S. stocks have gone up, mostly thanks to energy, but also tech and materials got upgraded, and every other sector has been downgraded. So no question the road has started, and we're seeing lower expectation, but so far larger, more important sectors are somewhat protected. So I'm not trying to say that it's all wonderful. I'm just trying to say that U.S. economy is probably, U.S. stock market is probably a better place to hide in than any other market. But so far, kind of tech, energy, that's enough for kind of support overall earnings in U.S. Other sectors are already seeing downgrades, no question about that.
All right, Marija, great having you on the program. Marija Veitmane there of State Street out of Milan. When you come to New York, and I imagine you must at some point, because everybody has to come to New York.
Everyone.
Stop by the studio. Join us.
Oh, I'd love to.
Join us live in person. It would be great to have you here. Let's check out what's going on in the markets right now. We continue to see gains, 0.5% gains, a little bit more on the S&P 500. So 65.70 is the level we are there. The NASDAQ now up 1% at almost 24,000, 23,974. The 10-year yield doing a whole lot of nothing at 432, 433, where it's been for a couple of days now, and the dollar also not moving much. Bloomberg Dollar Index down at 1211. The interesting thing, I think, is that you see significant drops in crude, regardless of the threats coming out of Iranian media. NYMEX down now under $100 solidly at 98.87, and Brent crude at 101.15. So I guess traders just looking through those headlines and not too concerned.
Yeah, Iran saying they won't reopen the Strait, still selling oil. Let's take a look at some of the single stocks moving this hour. Matt mentioned this one, a huge drop for Nike today, down 14%. It expects revenue for the fourth quarter to be down 2 to 4%, noting that turnaround efforts are taking longer than originally planned. Our retail reporter, Lily Meyer, reporting this morning that in an all-hands-on-deck meeting, Nike CEO basically showed frustration with the team, saying, I'm tired. I know you're tired about talking about the turnaround effort, but we got to get it done.
Right. Well, it's not happening right now, and as a result, investors are selling off those shares. Furniture giant RH also falling this morning after reporting disappointing earnings as it blames tariffs and bad weather for weak demand. Investors taking out a fifth of Restoration Hardware's value today.
I need to look up how much of their furniture is outdoor furniture.
I've spent a lot of time in the store, and all of the stuff I've bought, I bought it indoors and I use it indoors. So the weather never bothered me when I was buying stuff from Restoration Hardware.
Yeah, but I guess you're also less likely to go out shopping if it's raining outside.
Really? Are you?
Maybe. I don't know.
Go from my house to the car to the store, you know?
We're also looking at Intel this morning. It has agreed to pay $14 billion to buy back half of a plant in Ireland that it had previously sold in a JV to Apollo for $11 billion. In 2024, Intel up almost 8% this morning, rallying, though, with the wider chip sector.
Supposed to buy low and sell high, not the other way around. Somebody has to tell Intel. Coming up, dealmakers notching their best first quarter on record with a $1.3 trillion haul. We'll get the details next. And rising gas prices are stirring anxiety in an already slowing auto market. Later this hour, we're going to speak with Christian Meunier, the chairman of Nissan Americas. I recently got a first-hand look at the automaker's new Armada Nismo SUV. Real kicker is it's only $80,000 fully loaded. That compares to like $120,000 plus for a Cadillac Escalade V. And other than that, you can't get 460 horsepower in a full-size body-on-frame SUV. It's a really interesting opportunity in this segment. Now to high interest, look what's making headlines around the world. Anthropic accidentally published over 500,000 lines of code for its popular Claude AI agent, exposing internal workings, but no customer data. It's the second reported leak this week, and it's sparking alarm from security experts who warn that attackers could exploit the code to design backdoors into the system. And credit card companies are offering wearable tech perks to win affluent customers. American Express is giving a $200 credit towards an Aura smart ring, while JP Morgan's Chase offers a $359 rebate for a Whoop fitness band. The strategy appears to be working, but it's unclear whether demand will hold once those incentives end. Billionaire Nelson Peltz is buying Janus Henderson for $8 billion, and he's betting that AI can help fix the struggling asset manager. Partnering with tech-focused General Catalyst, he plans to overhaul and modernize middle and back office functions. The move caps years of pressure and fends off a rival bidder that spooked staff and clients. Dani?
Who was ironically called Victory Capital, that we spoke to, and Victory Capital was not victorious. Just along these same lines, dealmakers, they're off to their best start to a year ever, despite ongoing geopolitical uncertainty. Data compiled by Bloomberg showing that global transactions values ended in the first quarter were almost 20% higher at about $1.3 trillion. Joining us now is a reporter behind that excellent story, Bloomberg Deals reporter Michelle Davis. Michelle, I thought this was supposed to be a quarter where we were freaking out about AI. There was war, still supply chain risks. Still really good deal activity.
A record quarter. I mean, it kind of defies logic in some ways, but it also makes sense because in a lot of ways this year looks a lot like what last year looks like. You know, starting off with optimism and then geopolitics, all this uncertainty, tariffs, whatever, kind of put things to a halt. The difference is this time, companies and boards are saying, you know what, there might never be a perfect time, and like, if we want to do this deal, it's going to make sense 5 years from now. And so we can't just keep putting things on hold and wait for it to be perfect. Let's just do it now. Ironically, someone told me yesterday that the momentum or like their pipeline has accelerated in the last 2 weeks or since the war started because of that. That it kind of proved to people that it's really not going to get better. It could get worse. So let's just pull the trigger now and, you know, hope for the best. So
we don't see deals crippled by the war in Iran. And in fact, yesterday we were talking with HGGC. Rich Lawson said deals are still getting done even there.
Exactly. I mean, private equity has been one of the areas that has been a little slower. I mean, we've seen some big exits. Even this week, we saw Cisco buy a massive founder-backed, but also private equity-backed company in the food distribution space. But it just seems like, you know, it's a market that's kind of running on all cylinders. And the big why behind all of that is it really is the regulatory backdrop where it feels companies know and they've been told basically that anything's possible. There's also the midterms coming up later this year, and there's a view that maybe even if anything's possible now, if there is some sort of bloodbath there,
a rush
might make it a little harder to get things through.
By the way, is that why there's lots of consumer deals happening right now?
I think on the consumer front, I mean, it's been fascinating to see. just in the last 2 weeks, there's been, leaks and confirmations of 4 mega cross-border consumer deals. It's just all these companies have been waiting. They've been thinking about these deals forever, and I think the momentum is just finally theirs. And it's a bit of FOMO. They're saying, okay, well, our competitors are doing it. Scale is clearly important, so we might as well do it too.
Michelle, thank you very much. And I will see you in about an hour and a half's time, because Michelle Davis, as she does every week, will be joining me on Bloomberg Deals today at 12 p.m. New York time. I'm going to be speaking with David Gross, Bain Capital Managing Partner, and Tom Miles, Global Co-Head of M&A at Morgan Stanley. So a pretty good show, if I don't say so myself. And Michelle Davis, who's my personal highlight. More to come right here on Bloomberg Open Interest.
All right, let's get a check on the stock market right now. You can see that we're looking at gains here, up still 42 points to 65.71. So actually climbing throughout the session after we took a little bit of a hit from an Iranian headline. 311 stocks gaining, 192 down. So the breadth is to the upside. And you've got for the most part, Mag 7 stocks all on the winning side of the ledger. In fact, all of them are gaining right now. The interesting thing is in the losers, you've got the oil stocks down as the price of the commodity falls, but Nike taking such a huge hit, down 14%, as it said. Sales fell 2 to 4%, or going to fall 2 to 4% this quarter. In terms of the breakdown of industrial groups, you have energy, the biggest loser, and consumer staples. Everything else is up for a second day in a row. Coming up, pressure is building on the auto industry. We're going to talk to Nissan.
A check on markets this morning, and we still have a rally in our hands, despite the fact there's been some back and forth, more headline ping pong of the president saying that an Iranian ceasefire would need to happen with an open Strait of Hormuz. Iranian press saying that they will not open the strait and that it's up to them in Oman now to decide. But we are still off to the races. Some big rallies in big cap tech, in software names, in chip manufacturers. Rather, we're up 1.1% for the NASDAQ. That outperforms. 10-year yields, those start to come back down after we had little change on that index from hotter ISM prices paid. We're down. Actually, we're barely changed at this moment. Brent crude at 101, falling 2.5%, Matt.
That's, okay, oil is down. Oil continues. I just saw a headline saying crude inventories rose 5.45 million barrels. But we're still worried about the price of gas. In fact, gas prices above $4 a gallon are forcing car buyers to rethink what they can and cannot afford. That's adding pressure to an auto industry already bracing for a slowdown. Meanwhile, in the last hour, President Trump took to Truth Social congratulating Nissan for its manufacturing success in the U.S. Here to talk about all that is Nissan Americas Chairman Christian Meunier. Christian, great to have you on the program. I can't wait to talk about your products because I've been driving one recently, which I found really impressive. But I have to ask first about your manufacturing footprint. How important is it to you to be manufacturing here? And, what are you doing with your plants, for example, in Mexico?
So thank you for inviting me. I'm very honored to have received that congratulations from the President of the U.S. It's a big honor. And obviously, we're very focused on producing where we sell. And obviously, with the tariff, it's been an accelerator in the right direction. We've been forced to accelerate the localization in the U.S., bring more production in the U.S. And in our plants in Tennessee and Mississippi, we're maxing out the production. Just to give you an idea, a year ago, in the month of January, 45% of the cars we're selling in the U.S. were made in the U.S., and now we're above 60%. And the objective is really to reach an 80% mix of production in the U.S. for the U.S. At the same time, obviously, we still have a pretty significant footprint in Mexico, and we're building very affordable cars, so cars below $30,000, and we're very focused to get the cost down, obviously, to keep bringing them to the U.S. because affordability in the U.S. is a big issue, and obviously the tariffs are killing us at this moment. So we'll have discussion with the U.S. government and Mexican government to see if there is a way for us to have a little bit of a break on the tariff, because today at 25% it becomes very unsustainable. But we still absorb the cost at this moment and bring affordable cars. We have 6 cars below $30,000, and we're very proud of that. I think it's important for the U.S. consumers to have affordable cars with the right technologies and safety, and we're doing that.
Christian, how have those conversations gone with those respective governments, with the U.S. and with Mexico? Are you optimistic that they're going to give you some sort of break around tariffs?
It's been a challenge. It's been a challenge because I think these issues that we have on tariff is intertwined with other issues which are more political, and I don't want to dwell too much on that, but at least I think the governments are aware of the situation, and I think affordability is very important for the U.S. government, and hopefully we're going to get some good news in the next few weeks so that we can continue to have affordable Sentras and Kicks for the American consumers.
Why are you paying such big tariffs on Mexican cars? I mean, President Trump himself negotiated the USMCA. At the time, he said it was the best deal ever. And are your plants not USMCA compliant?
Yeah, they are. They are. So that means we have some benefits having USMCA product on the parts side. But for the cars that we bring to the US, unfortunately, we have to deal with 25% tariff. When, as you know, Europe is at 15, Japan at 15, and Korea at 15. So that means we have a disadvantage bringing the car from Mexico, which is a real problem because ultimately there are a lot of parts that are coming from the US, a lot of engineering resources that were used from Michigan to get the product developed in Mexico. So ultimately, it's a big challenge that we have, that 25%, and hopefully we're going to get some equivalent leverage versus the other countries for import duties.
Christian, what about the war in Iran? Is that creating any supply chain issues for you?
It's not been a significant impact at this moment. I think we're measuring and monitoring the situation in the Middle East every day. But so far, no impact, at least for this region, for the US. Obviously, for Nissan altogether, we're pretty powerful. We have a pretty good footprint in the Middle East, so that impacts the business. But altogether, we're managing and monitoring the situation. So far, we're managing well.
All right, I got to ask about the Armada. I test drive a lot of cars for my podcast, Bloomberg Hot Pursuit, and I had just spent a week in the Cadillac Escalade V, which, as you know, is a monster with a supercharged V8. Then I got into this Nissan Armada. It's the Nismo edition, so kind of souped up, 460 horsepower, 516 pound-feet of torque, and it is truly impressive. I mean, the handling capabilities just blew me away for something that is and feels like a truck. It drives so well and seems to be priced far below your competition. How can you make this vehicle and still keep margins strong?
I think we'll have the best-in-class product, and I'm also very much aware of what you're describing. I think the potential of Armada and QX80, which are siblings, is a lot bigger than what we're able to sell them today. I think it's mostly related to the fact that we're still limited in volume and availability. I think when we can increase availability, we'll have a little bit more marketing and advertising and promotion around the product. One project that we've been working on, and that makes me very excited, is a high-performance version of Armada and QX80 that is in a pipeline that I'm really eager to letting you test drive in the next few months. I think it's going to be a hell of a product, off-road, on-road. We need to bring some fun in automotive again. That's really critical.
I'm looking forward to it, Christian. You know, I've noticed the price of the Armada, of the Nismo, it compares, I guess, to Ford and GM vehicles, but they're all completely decontented. Like, when you option them up, your competitors start to cost $90,000 or $100,000 to your, like, $79,000. Why don't you decontent your vehicles like your competitors do and then force consumers to pay a ton of money when they want something like a heads-up display?
I think you're totally right. I think we need to be more customer focused, and sometimes we tend to have the wrong content. So my team and I are very focused on bringing the right product to the right customers at the right price. I think we need to have, the performance doesn't have to be super expensive either. I think we need to make it affordable for people to have fun and be able to enjoy a powertrain. If you make it too expensive, ultimately, you lose the potential to have people satisfied to drive the cars every day. You don't want to make it a niche product. I want the car to be seen. I want people to talk about it. And I think it's going to be ultimately good for Nissan. These are advocates for the brand. And affordability is core to the DNA of Nissan, and we need to keep it that way.
All right. Well, Christian, I really appreciate your time. Nissan Americas chairman Christian Meunier coming to us from the New York Auto Show, talking to us about doing business in the U.S. and some of his new product. Look forward to that new Armada as well. Dani, so basically what the deal is this. That is a full-size body-on-frame. It's a truck, essentially, but in an SUV form. And it has 460 horsepower. Now, you can't get really anything else with that much power in this market unless you go up to, like, the Escalade V. The other competitors, like the Ford Expedition or the Tahoe or the Yukon, with the 6.2 liter, they're priced around the same, but they don't sell you with that the heads-up display, which is you can see, your speed or your navigation in the windshield. Things like cooled seats or a full-size sunroof. They charge you extra for all of those things. Whereas this Nismo, it's all in one price.
Do people tend to pay up for all of that?
Of course,
because
you need all that stuff. So you look and you say, oh, it's only $77,000.
So the price tag is kind of an illusion then.
It's an illusion.
You're always going to end up paying more.
Exactly. So that's why I think this vehicle is so well priced compared to its competition. You can learn more about that on my podcast, Hot Pursuit, with Hannah Elliott. Download it wherever you get your podcasts.
Definitely one to listen to. First up on the show, though, demand for OpenAI shares on the secondary market is sinking. Meanwhile, Anthropic is running hot. We're going to discuss with Next Round Capital founder Ken Smythe. That's coming up after this commercial break right here on Open Interest.
OpenAI shares have fallen out of favor on the secondary market as investors pivot to Anthropic, its biggest competitor. The drop in demand coming despite OpenAI's race to raise tens of billions of dollars. In fact, $122 billion is the story today. Bloomberg's Hema Parmar joins us now on this. She wrote a great story on it, and it's such a fascinating battle here that I picked up and read your story start to finish right away. How did you find this and tell us about it?
It's so interesting when you look at the secondary market, because this is when buyers and sellers can trade amongst themselves in private stocks. And we don't see a lot of, it's private, right? So you can't get sentiment as easily as you can with a public share. And so when we look at what's happening with OpenAI and Anthropic, OpenAI being less in demand on the secondary market and Anthropic being in hot demand, one of the reasons is when we look at this valuation gap, and if you look at the chart here, you can see that OpenAI's valuation of $852 billion, how that compares with the $380 billion of Anthropic. Investors are betting that that gap is going to close. And if you think Anthropic's next round is going to be sizably more, these shares look pretty cheap. You're trying to get as many as you can. And we're seeing on the secondary, in some cases, it trading at a valuation of $600 billion or more.
Isn't there also a sense, though, that if OpenAI is going to be going public this year, that you still want to be in there? Even if valuations seem out of whack, isn't that a good place to kind of participate at the moment?
You get a pop, and then you make money off the retail guy.
Yes, and this is not saying that no one's in OpenAI. You also might see a lot of investors with current exposure and not seeking to add to their exposure, or people who have positions who are maybe primary investors looking and seeing, okay, well, I needed to participate in the next round. It's kind of frowned upon to not partake in a next round, and maybe seeking some liquidity or thinking that they have enough exposure and looking to offload that in the secondary.
Hema, fantastic story. Thank you so much for joining us. That's Bloomberg's Hema Parmar. And by the way, as part of the story, she spoke to Next Round Capital. And I'm pleased to say that the founder joins us now, Ken Smythe, a firm focused on the secondary market. And Ken, as you told Hema in the story, that you are seeing a lot of demand from VCs and other hedge funds trying to get out of their stakes of OpenAI. Can you describe to us just the level that you're seeing of disinterest and offload desire for OpenAI?
Yeah, I would say it's been, an interesting dichotomy to watch. I would say a year ago, we couldn't hang on to an OpenAI share for more than a day. before it was gone. What's happened here is obviously as a company has raised much more capital in the last year or so, obviously investors are holding on to a lot more stock. So in a bit, they've created a little bit of a supply glut, even though the demand is still there. There's just so much more stock out there that it's impossible for many, even of the largest investors, to absorb this much supply.
I had previously seen, Ken, or heard that funds like, the Robinhood Ventures Fund, we were talking with Vlad Tenev a couple weeks ago about that, were snapping up all of these shares, and that as a result, you couldn't get them. But I guess it's just a different story with OpenAI versus other, pre-IPO secondaries. Is that the case?
Yeah. So, in our world, when we look at, we focus very, very squarely on the names that are the closest competitors. And that closest competitor that has been gaining a massive amount of traction is Anthropic. As you recall, going back just several years ago, in fact, just a little over 3 years ago, Sam Bankman-Fried had invested $500 million in Anthropic at a $2.5 billion valuation. That stake today, just at the most recent round of $380 billion, would be worth over it would be worth over $30 billion today. And if you take $600 billion, which is where we're currently seeing the market in Anthropic, you're currently looking at his stake of a $500 million investment being worth about $60 billion. And that was made on behalf of FTX. Now, what we're seeing is that obviously as numbers reach the press, and we're talking about financial numbers, OpenAI is just simply losing a lot more money than Anthropic is. In fact, by 2029, OpenAI is on track to lose about $215 billion in total between 2026 and 2029, versus Anthropic, who is narrowing its losses and in fact will be profitable and is expected to report an $18 billion profit by 2029. So you're seeing investors really start to focus on the numbers, the amount of CapEx that OpenAI is spending on power and data, and Anthropic being viewed as just a more enterprise-focused and more disciplined current LLM than OpenAI.
What do you then make of the fact that OpenAI in its fundraising rounds is able to keep setting new records, that it raised $122 billion, that it was valued at $852 billion, which would make it the 13th largest company in the S&P? Is that a little bit of a disconnect then from what you're seeing on the secondaries market?
Yeah, so I think you really need to look at OpenAI and start to understand, a little bit how they structured this round, right? So Bloomberg, others have correctly reported that $122 billion is what they raised. But let's dig a little deeper and understand that that $122 billion includes $50 billion from Amazon. Amazon is actually not putting $50 billion of cash in this round. They're only putting $15 billion, 1-5, on the contingencies that OpenAI goes public or it reaches AGI. AGI meaning artificial general intelligence, which means that it can do anything a human mind can do. It can do as well, and it does not need to be trained to do it. Now, it may be tough for OpenAI to even prove that they've reached AGI. So right there, you can take that $50 billion, reduce that to $15 billion. Then you take SoftBank, whose headline commitment is $30 billion, when in fact it's only investing $10 billion over the next 3 quarters based on other milestones the company has to reach. Even more telling is that SoftBank actually borrowed $40 billion in a loan to actually fund their commitment of $30 billion, which are actually not putting to work. And that loan is a 12-month loan, which has to be repaid, or they have triggers on that loan. So you kind of have SoftBank making a levered bet. You have Amazon making a very careful bet based on milestones being reached. And so that $122 billion is really not a real $122 billion. It's a round that's based on a lot of contingencies. Moreover, what we saw is over $3 billion was raised from the private wealth market, including many of the Robinhood type platforms or others, including Cathie Wood's ARK Fund. to also participate in this round.
Yeah.
Versus Anthropic was purely all institutional.
Yeah, and all of it, again, leading up to the IPO later this year. Ken, we're going to have to leave it there. Thank you so much for joining us again. Highly recommend Hema's story that features Ken Smythe of Next Round Capital. Coming up, the Artemis II readies for takeoff in a historic flight around the moon. We're going to take you to the Kennedy Space Center next. You're watching Bloomberg Open Interest.
NASA astronauts launch tonight at 6:24 p.m. Eastern Time from Kennedy Space Center on a 10-day moon mission. It's humanity's first return to lunar space in over 50 years. And joining us now is Bloomberg Tech co-host Ed Ludlow, who's on the ground in Florida. Ed, it's fascinating. I guess this is just kind of in preparation for doing something that we did over 50 years ago, but is still somehow incredibly difficult.
Yeah, it's a high-stakes dress rehearsal for the SLS rocket system, principally developed by Boeing, and the Orion spacecraft or capsule developed by Lockheed Martin, for America and NASA's ambition to eventually have a human landing as early as 2028. There's also a geopolitical context that China aims to return to the moon's surface in 2030. So it is a bit of a land grab in that respect. In this instance, Artemis II does not include a landing. It is a 685,000-mile round trip that takes humans and Americans, 3 Americans and a Canadian, into deep space for the first time since that Apollo era. They'll basically be 4,000 miles off the moon's surface, 250,000 miles distance from Earth. And that's not the domain that America, at least, has been focused on over those last 50 years.
Can you talk about the costs of this, Ed, and more of the commercial aspects? Because it's a program that had long been delayed. What is the price tag looking like? Who are they working with? What does the net result of this project give us?
Yeah, all told, the Artemis program had a bill of about $93 billion or $4 billion per launch. And, you know, the original hope was that the system, SLS plus Orion, would launch in 2017. That never happened. There were technical delays and then COVID, and it launched uncrewed in 2022. So it's behind schedule. It is over budget in some sense. But if it goes at 6:24 p.m. Eastern Time tonight, it will be the most powerful human-rated launch system or rocket to ever leave Earth. 8.8 million pounds of thrust at time of launch. Starship, SpaceX's Starship, is capable of more than that, but it's not yet human-rated or close to carrying humans. So this is a big moment, technologically speaking, but that geopolitical context, of course, is key as well.
Is rocket fuel more expensive right now, Ed? Does that make a difference, by the way, because of the war?
I think that they may be a little insulated with their forward buying and contracts for the fuel supply.
Fair enough.
But note that this system is a hydrogen-based system and not, yeah. So anyway, we'll get to it later in the hour.
I was going to say, it shows my complete lack of understanding about how these things work. Ed, we're so lucky to have you and looking forward to Bloomberg Tech, which happens in about 4 minutes' time, and you're going to be following this story all day. Ed Ludlow there at the Kennedy Space Center.
I love to watch Ed talk rockets because he knows more about it than anybody else. So I'll be watching all day. I'm also going to be watching Dani's show at noon. Bloomberg Deals kicks off in an hour's time. And then tomorrow on Open Interest, Ben Snyder joins us from Goldman Sachs. This has been Open Interest.